Hey everybody, welcome. Before we start, I want to mention two things real quick. One, this video is for beginner traders, so if you're just now thinking that you want to learn about crypto trading, this video is for you. But also, if that describes you, then don't forget to check out the previous video in the series, Introduction to Crypto Chart Analysis. So this is the second video in our series of beginner crypto chart analysis. Today we're going to talk about trading crypto with moving averages. Before we start, don't forget to like, comment, subscribe, and share this video with your friends. Also, comment something good or interesting, some suggestions or feedback, and maybe you'll be a winner, because we're going to send a $15 trading bonus to the people who submit the 3 best comments. So, without further ado, let's hop in. The moving average is a calculation of the average price that an asset is trading over a set period. For example, if we're looking at a daily Bitcoin chart with the 20 MA applied, we're going to see what the average price is over the last 20 periods, or the previous 20 days if we have that set to days. In this video, of course, we're going to keep this as simple as possible. To truly develop an edge using moving averages, a trader should backtest as much as possible. But this is a good place to start. So let's answer the most basic question. What are moving averages? One of the most popular indicators across all markets, the moving average is exactly what its name implies. A calculation of the average price that an asset is trading over a set period. This can be in the form of moving average, which is just an arithmetic mean, or an exponential moving average, which assigns more weighting to the most recent prices. In this video, let's stick with the basic moving average, otherwise referred to as a simple moving average. For example, if we're looking at a daily Bitcoin chart with the 20 MA applied, we're going to see what the average price is over the last 20 periods, or the previous 20 days since it's a daily chart. Hence the idea of a simple arithmetic mean. We're taking the candle closing prices of the last 20 days and dividing them by 20 to get an average. It is important to note that we're looking at a moving average in terms of periods. So if we're looking at the 20 MA on the daily, we're seeing the average of the last 20 days closes. However, if we look at the 20 MA on the 5-minute chart, we're seeing the average price of the last 25-minute periods. The most common moving average lengths are the 9, 20, 50, 100, and 200. The lower periods are referred to as the faster periods, while the higher periods are referred to as the slower periods. These are also referred to as look-back periods. It's essential to understand that all of these periods are lagging. Moving averages are great tools for trading trending markets. They can be combined with either different variations of themselves or other indicators to develop systematic and discretionary strategies. Here are some great ways in which moving averages can be used. The first strategy is using moving averages to smooth out and determine the general direction of a trend. When the moving averages are pointing or sloped upward, this indicates that the underlying price action is currently moving in an upward trend. For some people, this takes out the subjectivity of paying attention to price action. For example, if we look at a daily chart and apply something like a 20-period moving average, we can see that the trend is up over time. We can also note some important details about the strength of the trend, regarding how extended prices from the moving averages and the periods in which the moving averages go from being more sharply pointed upwards versus beginning to taper off and even slant back downwards. These details can help us determine whether the trend is heating up or cooling down. For example, if we see the price is beginning to return to the moving average, the 20 in this case, we can see that the trend may be cooling off or even approaching what could be a period of consolidation. We can also see possible change in the trend if the price begins to fall under the moving average or if the moving average begins to turn back downward. Again, this is a lagging indicator, so it's only showing us what price is already doing, but it does help to make it a bit more obvious, although slightly late to signal. We can sharpen the idea presented by applying more than one moving average and watching for crossovers or cases where the moving averages are diverging or converging. In this example, we have a daily chart with the 20 MA in red and 50 MA in blue. For a trend follower, using moving averages can keep them in the trend for much of the move. In most cases, this involves using a combination of faster and slower period moving averages to identify the shift in the short term versus a long-term price action. Notice how these periods where the moving averages compressed during the consolidations, however, they did not cross. During these periods of compression, traders may look at adding to positions, so long as the moving averages maintain their position to each other. The trend shows signs of changing when we see the moving averages begin to interact and cross each other physically. One more way we can use moving averages is as dynamic supports or resistances. Let's say we have a powerful trend reversal where price has crossed and is now well extended and above the 20 MA on the daily. One of the better opportunities to buy a return back to the average. Many times this area will be systematically bought by traders looking to enter into fast-moving trends. Often, the first retest offers the highest probability of a bounce. Check out this image where price spends most of its time above the average and when finally revisiting for the first time, offers a substantial bounce. The inverse of this can be expected when the price loses the trend and falls below the moving average with conviction. In this case, the price loses the 20 MA on the daily, and this line then becomes a dynamic resistance. This wraps up some of the primary ways we can begin to explore using moving averages. As with all other indicators, these are just decision support tools that can be applied independently or with a combination of different forms of price-derived feedback. As with all approaches, be sure to backtest as much as possible. The benefit of using moving averages is that you can do this visually in a short amount of time. Alright, that's it for today's introduction to moving averages. We only talked about simple moving averages. Next week, we'll talk about exponential moving averages, or EMA, and go a little deeper. Thanks for watching. I hope you found this helpful. And again, give me suggestions and feedback in the comments. And if you comment something really useful, you'll be one of the top 3 winners and get a $15 trading bonus. See you guys next time.